Hello everyone, and welcome back to the channel. I hope you're doing well wherever you're watching from. As we reach the end of January 2026, I want to take a step back and look at what has just happened in the precious metals market, because honestly, this month will likely be remembered as one of the most dramatic periods in modern metals trading history. Across the board, precious metals have exploded higher. Gold, silver, platinum, and palladium have all posted massive gains, and not for just one reason. What we've seen is the result of several powerful forces hitting the market at the same time. Let's start with gold. Gold didn't just creep higher in January, it launched. Prices surged well beyond levels that many investors believed were still years away. At one point, gold pushed above the $5,500 per ounce level before pulling back slightly. Even now, it's still trading comfortably above $5,000, which would have sounded unbelievable not long ago. Silver, however, completely stole the spotlight. Silver prices went absolutely vertical. We saw silver blast through $100 an ounce, then $110, and even touch levels above $120 during peak volatility. Since then, prices have swung violently, and by the time you watch this video, silver could easily be higher or lower. That's how unstable the market has become. This kind of price behavior tells us something very important. The silver market is under extreme stress. A major driver behind silver's move has been growing concern over a massive short squeeze. For decades, large financial institutions have relied on a strategy of shorting silver futures, selling contracts forward, then buying them back later as they approach maturity. In normal conditions, this works because futures prices tend to trade at a premium to spot prices. But that strategy only works if physical silver is easy to source. And right now, that's the problem. Even if a trader is financially hedged, futures contracts still require physical delivery if the buyer demands it. If that silver is in the wrong location, or in the wrong form, or simply unavailable, the short seller is forced to scramble in the open market. That scramble appears to be happening right now. Inventories of deliverable silver are shrinking rapidly, and the number of paper claims on each physical ounce has reached alarming levels. This imbalance is what fuels short squeezes, and once they start, they tend to feed on themselves. Another key theme this month has been the disconnect between precious metals prices and official commentary. Despite gold and silver screaming higher, policymakers have largely dismissed the message. Recent statements from monetary authorities suggest that they do not view the metals rally as an important macroeconomic signal. Historically, that hasn't always been the case. In the past, rising gold prices were often treated as early warning signs, signals that something beneath the surface of the financial system was starting to crack. Today, that philosophy appears to have changed. At the same time, the US dollar has continued to weaken. After losing significant value last year, the dollar is now hovering near multi-year lows. When the issuer of the world's reserve currency downplays both rising gold prices and a falling dollar, markets tend to take notice, and not in a reassuring way. Trade policy has also played a role. Aggressive tariff threats, shifting messages about currency strength, and a desire to boost domestic manufacturing have created confusion. On one hand, there is talk of wanting a strong dollar. On the other hand, policies are being pursued that naturally pressure the dollar lower. Markets don't like mixed signals, and when uncertainty rises, investors seek safety. Historically, that safety has often been found in hard assets. One of the most interesting changes we're witnessing is how investors now view gold. Gold is no longer being bought simply as protection against inflation. Instead, it's increasingly being treated as insurance against systemic risk, against events that investors can't fully define but strongly suspect are coming. This is what some call the debasement trade. It's the idea that fiat currencies will continue to lose purchasing power over time, and that holding tangible assets outside the financial system offers protection. Investors aren't waiting for disaster, they're positioning ahead of it. Perhaps the strongest confirmation of this shift comes from central banks themselves. While official data is delayed and incomplete, what we do know is striking. Central banks collectively purchased hundreds of tons of gold last year, and early indications suggest that trend is continuing in 2026. When the institutions responsible for managing national currencies are accumulating gold at record levels, it sends a powerful message, whether they admit it publicly or not. Price forecasts are now climbing rapidly. We're seeing major financial institutions publish gold targets well above current prices, with some calling for levels north of $6,000 per ounce. Silver forecasts are becoming even more aggressive, with some analysts suggesting prices could move toward $150 if physical shortages worsen. Of course, forecasts are just that, forecasts. They are often wrong, either too optimistic or too conservative. But the fact that such numbers are being discussed seriously tells us how dramatically sentiment has shifted. While gold and silver dominate headlines, platinum and palladium deserve attention as well. Both metals are facing structural supply deficits. Production is heavily concentrated in just a few regions, and those regions come with significant risks, including sanctions, labor disputes, and political instability. At the same time, industrial demand remains strong, particularly from the automotive sector. As a result, users of these metals are increasingly choosing to stockpile supply rather than rely on just-in-time delivery. This behavior only tightens the market further. Ultimately, what makes this moment different from previous rallies is the physical side of the market. Paper contracts can be created endlessly. Physical metal cannot. In silver especially, the amount of metal available for immediate delivery covers only a fraction of outstanding futures contracts. That imbalance creates a fragile system, one where confidence matters more than ever. If even a small percentage of contract holders demand delivery at the same time, the system could seize up. January 2026 has shown us just how quickly confidence can shift. Geopolitical tension, currency weakness, supply constraints, and investor fear have all converged at once. No one knows exactly what comes next, days, weeks, or years from now. But markets are clearly telling us that something is changing. Gold and silver are not just rising, they are being repriced in a world where trust in traditional systems is fading. And when trust disappears, value tends to return to what is tangible, scarce, and universally recognized. Thank you for watching. If you found this breakdown useful, please like the video, subscribe to the channel, and I'll see you in the next one.